Well, it has been hard to ignore all the activity in the American political arena. This morning, we're getting our first look at what the polls are suggesting about how a Trump-Harris showdown might play out at the ballot box, the first major survey of Americans since Joe Biden's decision to drop his White House re-election bid over the weekend and endorse Kamala Harris, showing the vice president trailing former President Donald Trump in the polls by 2 percentage points, 47% to 45% within the margin of error. That would be an improvement, though, from the 6-point deficit Biden had been facing for his exit from the race. With big backers and a surge in funding, Harris could be poised for a short-term bump in the polls as she hits the campaign trail. But being in the spotlight will mean squaring off with Team Trump, which has felt plenty of momentum after the assassination attempt just over a week ago. Now, with all of these incredible developments, there is still a deeply divided country in the U.S., could ultimately make it hard for the polls to ultimately swing too much in either direction. And as the markets watch this, we in Canada are also watching it and trying to think about the ramifications for our country. This hour, we're going to have an insight, great conversation with Mark Wiseman. He's the former chair of Alberta-based AIMCo, also previously served as the head of the Canada Pension Plan Investment Board. Mark, it's great to see you again.
John, great to see you.
And we're going to talk about a lot, but I figured we'd start with this broader story because it feels like an unprecedented period in American politics. And as you've been observing the situation, what's been top of mind for you?
Well, look, I think this is arguably the most important election in the United States for every country in the world except the United States of America. I think it matters to us in Canada, very, very importantly. It matters to Europe. It matters to China, which I think we're going to talk about a little bit later. But if you think about the U.S. for a moment, and you think about the economy, which is where my focus is and what this show's focus is about, imagine the day after the election in November. If Trump's the president, do markets move? If Harris is the president, do markets move? Probably not. Because I think for financial markets, by and large, it's heads we win, tails we win. The U.S. is continuing to power ahead. It looks like we're going to have a soft landing in the U.S. if we have a landing at all. And in addition to that, a Trump presidency, well, what's it mean for the economy? What's it mean for markets? It probably means an extension of tax cuts. It means deregulation. And it means probably some increase in tariffs, which by and large is good for business in the U.S., at least in the short to medium term. A Harris presidency probably continues the path of Biden, which means more stimulus, increased spending, maybe some tariffs. But again, by and large, a positive story, a different positive story, but a positive story for business and for markets in the short to medium term. Longer term, bigger issues on either side. But unless you really care, and I'm not saying people shouldn't care about it, but unless you really care about things like reproductive rights and you know, institutions in the U.S. and so on and so forth, for the economy, I don't think that Trump or Harris is going to have a huge difference.
Let me ask something. I haven't really brought this up with any guests yet, but there had been a growing narrative around a much more integrated North American economy. Just because when we talk about geopolitics, before we start talking about the election, we talked about some of the growing tensions around the world. And I do wonder, with all the rhetoric that we likely will continue to hear on the campaign trail in the United States, and officials in Ottawa probably listening very closely and wondering what that all means for trading relationships with the U.S. and Mexico, are you concerned at all about that we have been kind of moving towards a much more integrated economy? We already had a trade deal that was hard fought for, and now we have to kind of figure out what's going to happen in the years ahead.
Well, let me be clear. Again, this is the most important election in our lifetime for every country in the world other than the U.S. And I think it matters immensely to Canada, the outcome of this election. I think a Trump presidency will be extremely challenging for Canada. We're more likely to have tariffs that would potentially have an impact on Canada and perhaps unwind all or part of the USMCA, which comes up for review in 2026. We have a situation where we know that a Trump administration can be bombastic, can be knee-jerk in terms of its reaction. And we know that it's been critical of Canada, sometimes right, sometimes wrong, on our policies north of the border. including on things like border control, including on things like spending on defense, et cetera. So I think for Canada, like Europe, like other parts of the world, a Trump presidency is going to be a big challenge for us, and I'm not sure we're ready for it.
So let's put that in context with where the economy sits right now. We're just on the doorstep here of another decision on interest rates. We'll see ultimately what the Bank of Canada decides to do. But a resilient American economy has benefited Canada. But at the end of the day, we have seen a divergence between the Canadian and U.S. economies. So what's your current view on where we sit as an economic growth story?
Yeah, look, where we sit, especially relative to the U.S., is pretty poor. Again, the productivity gap, we've talked about this before on the show, is now 27% between Canada and the U.S. GDP per capita in Canada is about 80% of U.S. GDP per capita. If we were a state, we'd probably be something like Kentucky. And, you know, all of the growth that the U.S. is experiencing, including around generative AI, including on productivity gains, and just the general resilience of the economy is not showing up here. It's not showing up here in terms of GDP, particularly GDP per capita. It's not showing up here in terms of job creation. We're running significantly higher unemployment in Canada as compared to the United States. And in fact, it's led to perhaps softer inflation in Canada as a result of a slower economy, which may allow the Bank of Canada to ease on monetary policy in the upcoming announcement, maybe take down another quarter basis point. But that creates another problem. And the problem that causes is pressure on the dollar, because, you know, bond markets, they move like water. And, you know, Canadian debt becomes much less attractive, and therefore Canadian dollars become much less attractive with our interest rate lower than the U.S. And I don't think the U.S. is going to be able to cut as aggressively or as quickly as the Bank of Canada might be contemplating.
And the other big thing we've talked about from time to time during this interest rate hiking cycle, and now I guess we're officially into the pivot now, but the fact that Canada has been more sensitive to the higher interest rates, if only because of our shorter mortgage duration market and the fact that there's a lot of people in the housing market and a huge demand for housing in this country. And we're going to see a wave of renewals over the next few years. And we kind of drift in and out of that conversation. But how much attention do you think we should be giving it right now?
I think we have to be giving it a lot of attention. I'm sure that's one of the things that the Governor of the Bank of Canada, Tiff Macklem, is looking at. OSFI has warned on the mortgage renewals that are the wall of mortgage renewals that are coming up, and it's going to really further hurt housing affordability in this country. And that's a lot of that is just it's as you say, it's the difference in the structure of the market. There's a different problem happening in the U.S. because of the long-term nature of mortgages, and because people have their mortgages locked in. There's very little supply in the market in the U.S. because no one's selling. If you've got a 30-year mortgage at 2.5% and there's 27 years left on it, you're probably not selling your home right now. You might rent it out, but you're definitely not selling it. So the U.S. actually has a supply problem as well, but it's different than the Canadian problem. And the nature of the structure of the Canadian mortgage market means that we have a lot more fragility. And I'm sure that's one of the things that the Bank of Canada is taking into account, and certainly OSFI has called it out.